I'd like to start by thanking Chester for that very generous introduction and thanking the program committee for inviting me to participate in this terrific conference on systemic risk and data issues. And I'm particularly pleased to be part of the session on the shadow banking system because I think that that really is at the heart of systemic risk and data issues. And I'm going to try in the next 15 or 20 minutes to illustrate to you why that is, particularly for the hedge fund industry, which I was asked to speak about. Now, before I begin, let me ask, how many people here are actually familiar with the hedge fund industry? Yeah, not everybody. So I have to admit that, until 1998, I really didn't know much about the hedge fund industry either, but LTCM really put that industry on the map, particularly for academics. And when I asked one of my friends at the time, how to define a hedge fund, he gave me an answer that I didn't quite understand at the time, but I think I do now. And the definition was kind of interesting. He said, a hedge fund is a partnership. It's a private partnership that has limited partners and general partners, and it lasts for a finite amount of time. And at the start of this partnership, the general partner brings the investment experience, and the limited partners bring the money. And at the end of the partnership, the general partner leaves with all the money, and the limited partners leave with all the experience. So, there's a lot of skepticism about hedge funds, but the fact of the matter is they're big and popular and more active now than ever, and we don't know a lot about them. So I want to describe to you just how much we don't know. And to do that, let me first start by describing what we do know about, say, the economy. So let's just go down the list and think about the top 5 or 6 statistics that we cite when we talk about how the economy is doing. We know that inflation, as of last month, was 3.8%. We know that unemployment is at 9.1%, serious problem. We know that GDP growth is at 1.3%. We know that non-farm payroll is at 0 change from last month. We know that housing starts are at 3.2%. And we know that the Fed balance sheet is at $2.8 trillion. We know a lot about the economy, although I think that all the economists in the audience would agree that that's not nearly enough for us to really get a good sense of how to manage the system. Now let me show you what we know about the hedge fund industry. This is what we know about the hedge fund industry. Now when I say that, I'm using the word know in the legal sense. Can you actually base a regulatory action on information that you can actually verify in the hedge fund industry? And the answer is no, because hedge funds aren't obligated to report. Now, there's a lot of things that we think we know about the hedge fund industry, so let me tell you about that. But after most of these so-called facts, I have to qualify them by saying that we don't really know. So, for example, we think we know that the hedge fund industry is larger than it's ever been. The estimates are that the hedge fund industry today is at about $2.3 trillion. Now, Russ just before mentioned that the money market funds are about $3 trillion, so it seems like money market funds are bigger, but that neglects the fact that this $2.3 trillion is without leverage, and it also neglects the fact that these $2.3 trillion are not invested in AAA bonds with credit protection. Second, the industry, we think, is becoming more concentrated. Thanks to the financial crisis, a lot of investors now no longer want to invest in the small startup hedge funds. They want to invest in big, stable, institutional quality hedge funds. And that means that there's a much higher concentration. I'd love to be able to show you a graph of the Herfindahl index, but I don't have one because we don't have data for that. The biggest source of new inflows, we think, are pension funds. And that's a source of concern because pension funds, as most of you know, are mostly underwater right now. They're trying to boost their asset growth because their assets are below their liabilities, and by ERISA laws, they are actually in violation and going to have to make contributions. So they're looking for higher yielding assets, and the only place to go when you're looking at higher yields, if you go through the historical data, as misleading as it is hedge funds. Traditional strategies are underperforming. as far as we know. We're not sure because we don't have regular reports, but things like convertible arbitrage, statistical arbitrage, global macro, all sorts of strategies have really faltered over the last couple of years. There are pockets of good performance, but some of the traditional strategies have really had a hard time. The returns are becoming more highly correlated. That is, the returns that we observe. And we only observe the returns that hedge funds voluntarily report. So the TAS database, the Morningstar database, those are databases of hedge funds that have voluntarily agreed to share with us the returns. But for the most part, we don't have access to what's really going on in the larger and broader industry. We think that leverage is more dynamic, meaning that now hedge funds are moving their leverages around much more rapidly as a function of market conditions. We think we know this because we talk to prime brokers, and brokers seem to suggest that that's what hedge funds are doing. But of course, there are a number of hedge funds that use multiple prime brokers, and they spread their trades in ways that can be very difficult to tell what's going on. And finally, it seems as if hedge funds are becoming more short horizon oriented for a variety of reasons that make sense. But in fact, we don't really know that. It just looks that way from the data that we have access to. So that's a lot of hemming and hawing and hand waving, but that's where we are right now. And so let me just share with you a little bit about size, because Rob Engel at lunch today gave his list of top 10, and Russ had his list, so I've got to come up with a list as well. So my list is the list of top 25 hedge funds as of the end of last year, as surveyed by Institutional Investor. And you probably can't see in the back, so I'll just read off a couple of names. None of these are real household names, except for maybe one or two that are old-time hedge funds. But the largest hedge fund today is a company called Bridgewater Associates. They're based in Greenwich, Connecticut. They've got $58.9 billion. That's one institution, one hedge fund, has $58.9 billion. What do? We don't know. Multi-strategy, currency trading, futures, they could be doing any number of things. Their offering memorandum is pretty broad. JP Morgan Asset Management is $54.2 billion, Mann Investments $40.6. Paulson and Company, the fellow who bet against the mortgage market years ago, Paulson and Company has $35.9 billion. In 1999, in the aftermath of LTCM, Paulson was an analyst. He hadn't started his hedge fund until 2003. He started a hedge fund with $300 million. He's now at 35.9. Actually, I think it's a little lower because he, as some of you may know, he lost 30% over the last 2 months. Now, the smallest hedge fund, ESL Investments, on this top 25 list is $14 billion. And $14 billion may not seem like much in the grand scheme of things, but remember that these assets are highly leveraged and very dynamic and invested in high volatility assets. And you might say, well, geez, there's been a lot of inflation, maybe these assets are really not as much as they were, years ago. So let me show you by comparison in 1998 dollars, during the days of LTCM, what these assets would look like. In 1998 dollars, Bridgewater has $42.4 billion. In fact, the smallest hedge fund on this list, ESL, has $10.1 billion. And just by way of comparison, LTCM, you remember that fund. They sort of got in a little bit of trouble in 1998. They had $4.7 billion. That's right, but at their peak, they were at something like $8 billion, right? Which is still smaller than the hedge funds listed here. And the list actually goes on quite a ways, obviously. So, this should be of some concern. The fact that we have very large, very active investors that are basically opaque. So to give you one example of the kinds of things that we might be able to do to get some understanding of what's happening, let me just quickly review some research that I've done with Amir Kandani. Amir is a former student of mine who's now at Morgan Stanley, and he's here today sitting in the back. So I may call on him to comment on some of these things from his current perspective. But in August 2007, something really strange happened. And when I asked this audience what happened in August 2007, My guess is the most common response is, oh, the LIBOR OIS spread blew out during that second week of August, and the Fed and other central banks had to inject liquidity on that Thursday and Friday. But if you ask the hedge fund manager what happened in August 2007, they probably wouldn't start with that. What they would start with is the Quant meltdown, the fact that all quantitative equity market neutral managers seem to have lost money exactly at the same time during the second week of August for no apparent reason at all. And it was so strange that the Wall Street Journal wrote an article about this, how market turmoil waylaid the quants. And so going through this, I got curious because several of my former students who went into this industry called me up and asked me how things were going, what was going on, and did I hear from any of my other former students that were in the quant equity fund? And so finally, I called on Amir, who was a graduate student at the time, and I said, Amir, we ought to look into this and try to figure out what's going on. But of course, nobody's talking because this is the hedge fund industry. There's no transparency. So Amir and I decided to simulate a very simple strategy, a mean reversion strategy. Today, you buy yesterday's losers, and today you sell yesterday's winners. So you're basically simulating a market-making strategy. And let me show you what the simulations look like. Now, we simulated it originally for daily, but then we got a hold of transactions data. So we were able to simulate it for 5-minute, 10-minute, 20-minute, hour returns. And so this is a graph that shows you the cumulative profits of this mean reversion or market-making strategy during that second week of August. We actually simulated from July 2nd to September 30th, 2007. If you simulate a 1-hour mean reversion strategy, the cumulative profits look like that. It's slightly positive, a little bit of a dip right around that second week of August. Now if you go half an hour, a bit more of a dip. And if you go 15 minutes, a bit more of a dip. If you go 10 minutes, a bit more of a dip. And now if you go at 5-minute intervals, you see something interesting. A high frequency, at the time it was high frequency, now it's pretty slow and plodding. But back then, at 5-minute mean reversion strategy, started losing money at the beginning of the week. And ultimately, it lost quite a bit of money and then effectively recovered and became profitable thereafter. From this kind of simulation, we can piece together some conjectures. We conjecture that there was a massive deleveraging that occurred during the first 2 weeks of August. It actually started August 1st at 10:45 a.m. and it stopped at 11:30. You can actually see that from the tick data. On August the 6th, the second wave began at 9:30 and it went until 1 o'clock, and it affected particularly earnings momentum and book-to-market portfolios in the financial sector. On August the 7th, price momentum and cash flow to price portfolios got hit. August 8th and 9th, all groups lost money, and there was a sharp reversal on August 10th, all of which seems to suggest that there was some kind of a massive unwinding of a stat-arb portfolio during that week. Now, when we wrote this and published the paper, we felt a little bit odd about this because I don't think we've ever written a paper, I certainly haven't, where you're actually writing about something where you're making a guess and you know for a fact that there are people out there that know what actually happened, but they're not talking. So in fact, this entire paper could be science fiction or it could be dead on. We have no idea. To this day, we don't know because nobody's talking. They're not allowed to talk because that would disadvantage their shareholders. Just out of curiosity, you might wonder how that strategy is doing. Well, this is the 1-minute cumulative return strategy starting in 2006, and the strategy's been working pretty well at a 1-minute interval until just about a year ago. And it's actually having a very hard time right now. Now, maybe we have to go to the sub-millisecond level. That's possible. But the point is that this industry is extraordinarily dynamic. Hedge fund managers and investors go where the money is. And if the money's not here, they're on the move and they're doing something else. Right now, they're doing something else. We don't know what that is. A second example is some work that I've been doing on Granger causality networks with Monica Bilio, Mila Getmansky, and Loriana Pelizan. Here, we're trying to understand just how interconnected the financial system is. And so we use standard Granger causality tests to measure the relationship between the monthly returns of hedge funds, broker-dealers, banks, and insurance companies. And what we find is that when you graph these networks, these are relationships that have a 5% level of statistical significance between one institution at time t and another institution at time t plus 1. It looks like a bit of a yarn ball here, right? This is a 3-year period from 1994 to 1996 where we're graphing all of these connections. The color coding tells you what the institution is, red for hedge funds, green for broker-dealers, black for insurance company, and blue for banks. And you can see that there are definitely connections among these institutions back between 94 and 96. Let me show you what the graph looks like from 2006 to 2008. So that network is a lot denser, and denser still even today. And you notice that it's not just the banks and broker-dealers that are responsible, but the hedge funds have tremendous connections to these. And that's a sector that nobody knows anything about. In fact, we don't even know how many hedge funds there are. I can tell you right now that there are 3,990 stocks trading on the New York Stock Exchange. I can't give you a number for hedge funds. I don't think anybody knows how many hedge funds there are. And I suspect that that's an issue. So the point is that indirect measures are suggestive, but they're not conclusive. And think about the National Weather Service or the Geological Survey or the Census Bureau and about how they do their work with the data that they have. And now imagine if you don't allow them to have the data, how can they do what they're supposed to do? We need data in order to talk about systemic risk. And that's why this conference, I think, is so terrific, because it focuses on exactly those two issues, data and systemic risk. Now, the problem with data is that there are privacy issues, particularly with financial institutions, because you want to be able to allow financial institutions to develop proprietary technologies without having to give away their secret sauce to their competitors. And so there's a tension then between privacy, the need to have confidentiality, and the need for there to be some kind of disclosure. So the question is there some compromise that we can strike between the two? Because this is a really serious problem, and hedge funds in particular are being very recalcitrant about trying to give up any of their highly valuable information. And so I want to tell you and conclude with the answer, yes, there is a compromise. In fact, it may not even be a compromise. We may be able to have our cake and eat it too. And it has to do with some research that's been going on in the computer science field known as secure multi-party computation. Amir and I are working with a third co-author, Emmanuel Abe, a computer scientist who's here as well in the back of the room. And what we're trying to do is to develop methods that will allow us to compute systemic risk, but in a completely private way. And in order for me to illustrate that, I have to give you an example. So let me give you an example about something that all of us feel rather private about. Let's say our salaries. It'd be interesting to know what the average salary is in this room. And so let's just start with a quick survey, shall we? So let me ask Lemma. Lemma, would you mind telling us what your salary is? Oh, well, I see. So my guess is that most people, despite these kinds of publications, would not be very comfortable talking about salary. So let's try to think about whether we can come up with a method for calculating the average salary in this room without anybody having to reveal their salaries. Now, how could that be? That seems ridiculous. Well, I'll give you an example of how we can do this. This is using an idea that was developed in the computer science literature about 30 years ago. I'm going to start. I'm going to give Lemma my salary, but I'm going to add to it a random number that I select. So only I know what that random number is. So the number, Lemma, is $315. That number is my salary plus a random number that I picked. And I'm going to give that number to you and no one else. So only you know that number. You're going to do the same thing. You're going to take my number, Y1, and it's close to your salary? No, well, Maryland is not a state school, is it? So, all right. You're going to take my number, which is my salary plus a random number, and you're going to add to it your salary plus your own random number. And then you're going to take that number, which is Y2, and you're going to give it to Richard. And then Richard's going to give his number plus a random number to Nancy. Nancy's going to give her number plus a random number to so on and so forth, until finally Chester's the last person, and we give Chester the number plus the random numbers for everybody, and Chester adds his salary plus his random number. So now what Chester is in possession of is the sum of everybody's salaries and the sum of everybody's random numbers, which means nothing. It's garbage, right? But then Chester now gives me that number, subtracting his own random number. And then I take it and pass it to Lemma, and Lemma, you subtract your random number. And Lemma, you give it to Richard, and he subtracts his number and passes it to Nancy, and so on and so forth. By the time it goes back to Chester, what does Chester have? When Chester subtracts his random number, he has the sum of everybody's salaries. And when Chester divides by the number of people in the room, we then have the average salary of the room. Nowhere and at no point did anybody have to reveal their salaries. Now, this is a pretty simple idea, but you see the power of it. And there are ways to break this by colluding. For example, if I colluded with Nancy, I could probably figure out a way, if I could measure other people's incremental changes to try to eke out information about people's salary information. And if enough people collude, then we can figure it out. So if everybody in the room but Chester is in on it, we can figure out Chester's salary. But it requires all of us to collude, which is pretty hard to do. I don't know how many of you have ever dealt with investment banks and financial institutions, but getting them to talk to each other is a challenge, never mind getting them to collude. So the point is that in a paper that Emmanuel, Amir, and I are working on, we actually show that using cryptographic methods, you can compute securely, privately, means, standard deviations, correlations, COVAR, marginal expected shortfall, all of the statistics that you would like to have for systemic risk measures securely with multi-party privacy. And the reason we did this is because our view is that you don't need all the data. In fact, I think that that's a ruse that the industry has put up, which is to say, oh, well, we can't possibly do this until you OFR guys, you get all the data and then we'll talk. You don't need all the data. You can compute systemic risk statistics in a secure and efficient manner using technology that we have available today. So this is just an illustration of some of the things that we do in the paper. I'm going to let Emmanuel explain this if any of you ask me about it. But these are encryption algorithms that basically take simple 0-1 computations and show that you cannot reverse engineer floating point operations in any meaningful way. There's no more excuses in our view once we show how this is done. So let me summarize by saying that there's lots of applications for this. One application that is related to some work that I've done with Amir and another co-author, Adler Kim, is looking at consumer credit risk. We were able to get 1% of customer data from a major bank with all of their credit card transactions, all of their banking account transactions, as well as their credit bureau history. And using this 1% data, we were actually able to increase the forecast power of consumer credit delinquencies and defaults by a factor of 10. And this is extraordinarily proprietary data. In fact, one of the things that we were not allowed to get from this data was zip codes. And we wondered, why the heck can you not give us zip codes? We just want to know which part of the region of the country was affected the most. Well, apparently there's a law against that because of redlining. So data issues are tremendously important. And let me summarize by saying that because the financial system is much more complex, really measurement is the first step in addressing that complexity. And the OFR is absolutely central to this effort in terms of its data mission, standards, analytics, and research. But financial innovation does require privacy. And we think that multi-party computations can resolve this conflict. So, let me conclude by saying that, these privacy issues may be new to economists, although the mechanism design folks, I think, have been working on this for years now. But for most of us, privacy is relatively new. But I came across a story that somebody told me recently that brought this home to me. It was a story about a 11-year-old boy who at school learned that you could get people to tell you all sorts of secrets, to give up their privacy, if you simply told them, I know everything. I know it all. And so this boy tried to do this. One day he went home and went to his mother and he says, Mom, I know everything. It's not a secret anymore. And she said, listen, son, here's $20. Do not tell your father. So the next morning, the boy says to his father, Dad, I know it all. I know the secret. And the father said, son, here's $40. Do not let your mother know that we talked. And so the boy said, this is pretty good. And he's on his way out to school, and he sees the mailman, so he decides to try to the mailman. He goes to the mailman, he says, excuse me, but I want to tell you that I know the secret. I know it all. The mailman, shocked, drops his bag and says, son, come to daddy. That's the best reason for multi-party security I could think of. Thank you.
Well, thanks for that. Thanks for that terrific talk. I'd like to terrific talk on many different levels. I'd like to open it up to questions.
Well, I think it's fascinating, the secure multi-party computation. I'm sure many of the audience does as well. My question is this, though. We all know that averages are dominated by the largest salaries, so maybe Lemma's salary is dominating the average. And in the case of the long-term capital in 1998, you made a point to note that long-term capital was much smaller than the dominant hedge funds. So as this is an interesting way to measure systemic risk on an aggregate scale, how do we pinpoint those smaller hedge funds, which may actually be the risk triggers, but may be dominated in your metric by the larger hedge funds?
Well, so I think that that's actually not as hard as you might think. The first step in any kind of regulatory action is to first document that there's an issue, because if you don't, that there's no point to being able to start any kind of an action. But once you document that there's an issue, so let me give you an example. One of the things that we show in our paper you can compute securely is the Herfindahl index for a group of parties. If the Herfindahl index shows that there's extraordinary concentration, that's the smoking gun that a regulator can then use to say, now it's time for me to have a conversation with the top 10 prime brokers. And very quickly, you will find out from talking to those brokers exactly who has the very biggest exposures. But the point is that that conversation doesn't even happen because no regulator is going to feel like they want to go out and talk to prime brokers on a regular basis and just say, tell me all of your secrets. Let me know what's going on right now. You've got to have a reason to go into their offices. And what we're trying to do is to create that reason.
Yeah, it's Pete Kyle again. How do you prevent Chester from manipulating the statistic by lying to convince everybody else that finance professors are grossly underpaid?
Very simple. You institute random verification checks so that you draw, take all of the names in here, draw the name out of an urn, and you verify, and the person that lies, you shoot them. That's all you need to do.
This is what I thought you were going to say. And you see this in the SEC proposals, for various types of disclosure. It requires that you have a name, address, and a telephone number, a place of business, and that you have records that you can inspect, and that you be able to send in some kind of auditor to collect the information. That is a fairly burdensome requirement.
That's true if you have to do this.
For any entity.
Absolutely, that's true if you have to do this in person. But the cool thing is that we now have computers, and we have this thing called the internet, and we have servers, and even the SEC has servers, and the servers can actually tie with the internet to these various institutions, and the institutions can actually send messages, and the messages can be verified, and you can actually check every once in a while that the address is correct, the phone number is working, and so on. I think that technology is the key to dealing with this in a manageable way. By using technology and leveraging it, I think there's tremendous things that we can do that we're not doing now.
Mark Flood, OFR. The encryption technologies are a silver bullet if the only problem you're trying to solve is a privacy problem. But the more general case of the issue that Pete just raised is data quality. And if data quality issues are pervasive, which I think they are, how do you reconcile if every day you're discovering strange results coming through in the aggregates?
So garbage in, garbage out, you're absolutely right. And we're not commenting on the fact that this is going to solve all the problems. Obviously, data quality is a very important issue. Globalization, being able to integrate different kinds of data fields and ontologies is a challenge. But I think it's less of a challenge when you can guarantee to various different counterparties that their data will be secure and that you don't need all of their data. You only need those pieces of data that will be relevant for systemic risk computations. So I think what it does is it lowers the bar, or it reduces the threshold by which you can actually do something useful and still be able to demonstrate to the various parties that they're not going to be giving up their golden eggs to their competitors.
Pete Axelrod, DTCC. Just some of the horses left the barn. At full disclosure, our company is a strategic partner of the Managed Funds Association, but we've been publicly taken to task a lot for handing out hedge fund data to any regulator that asks, or not quite, any regulator with a material interest. In fact, they've all signed something that said we could do that. I think the Dodd-Frank Act is going to make all hedge fund swap data in a mirror available to regulators worldwide, and I think they are gradually coming around to the fact that regulators are going to see what they're doing, regardless of how hard they fight, because really regulators are concerned with more market manipulation than systemic risk, and they want to see the trade level data.
Right, but I think that the best way to respond is that when my 11-year-old son gets asked to clean his room, somehow he drags that into like a 2 or 3 day process. On the other hand, when his mother tells him that the only way he can go get to see a movie is if he cleans his room, somehow it happens in half an hour. It's funny how that works. So I think that we're going to see the industry dragging their feet until and unless we actually show that there's a credible mechanism by which not only can we get their data securely, but that they themselves will benefit from the data. So in the example of banking transactions, you can actually lower the cost to banks for engaging in credit if you show them a more accurate way of measuring risks.
What? Oh, did you? Oh. Sorry.
I know who you are, Joe.
Okay, good. You said that you could verify by essentially a sample of them, but all you have is presumably the best you can get is their information plus the random number. So unless you can actually dig back down and get the cumulative sums all the way around, and then
Sure. Yeah,
random numbers, you're going to have everything.
Yeah, no.
You have everything.
Absolutely. What I gave was just a very simple example. In the few minutes that I had, it was enough to illustrate, that it could be done. But in fact, the algorithms that are used in, for example, the RSA technology that all of you rely on when you enter your credit card number on that Amazon website, that's quite a bit more sophisticated. And so those algorithms are the ones that we use and where you can actually engage in verification as well.
I mean, because you're going to actually have to come down and therefore be able to identify what they actually had
That's right.
to begin with.
Absolutely.
Well, if you can do that, then they might as well tell you what they actually had.
Well, no. You verify, on a random basis that they're not lying. And but the random basis has to come with extreme penalties. So what you've done is to reduce the verification problem from verifying 1,000 participants to verifying 1 every few years.
I know, but if you're verifying, that means that ahead of time, you've identified what they said, what their salary is. So you now know for each individual what their
No. You have their audit trail for what they submitted. You don't have to know it at the time you're actually measuring it. But at the time that you engage in a verification, they display audit trails that are actually stored by the central server. So you can actually connect the dots when you need to. The point is that you're not connecting the dots every single day.
To answer Mark's question, can't you just do it if you use a vector instead of a scalar? So instead of you giving me your salary plus a random number, give me a million numbers of which one of them is your salary, ask everyone to do it, and then when you subtract it out,
Right.
you then have a set of scalars at the end
Yeah.
instead of the sum, in which case all of Mark's, you can do statistics whatever you want, but
Right.
still relatively secure. And
Yeah, sure, for example, but there are even stronger methods that are robust to collusion.
So I think you convinced me that the hedge funds that are going to lie are the ones that are in dire straits and a great deal of trouble, where fraud is going to be occurring anyway, and they don't have any assets to seize, so that you can punish them when your policeman comes around to check their integrity.
That works for me.
Okay. Well, all right. So let me thank the audience and especially the two presenters for a very interesting session.